Hello, chart watchers, and welcome to this Thursday, June 27th, 2019 Market Watchers live show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market got off to a pretty good start today, although we are off earlier highs. The Dow Jones Industrial Average actually has moved into negative territory, down 25 points. The S&P 500 is up 8. The NASDAQ leading on a relative basis so far, up 35.5 points. The Russell 2000 also having a very strong day, actually the leader among the major indices, up about 0.9% today, up 13.5 points. The 10-year Treasury yield starting to roll back over just a bit, down about 3 basis points, 2.02%. Volatility index continues to just kind of be hanging in there in this uptrend that we see started about a week ago, a little over a week ago. Real estate bouncing after 4 really bad days. So we are seeing a little bit of movement here, holding that 50-day moving average, but trapped between both the 50 and the 20. Financials, a little surprising here. Financials doing well today despite a drop in the 10-year Treasury yield. Maybe that's a signal things worse things are behind us. But I would just look up here at this 2750 area where we have seen multiple failures. I think a breakout above that would be bullish for the XLF. Healthcare, which had a very strong June, has seen profit taking here in the last week. But we are bouncing a little bit on the heels of biotechs, which were outperforming just a bit within the healthcare space. Energy having a rough day. All industry groups within energy are down except for renewable energy. As you can see right here, renewable energy having a very strong session, trying to break out again. But we do have drug retail moving higher to a 2-month high, as you can see, and furnishings also bouncing nicely. Within that drug retail group, Walgreens, they came out with their earnings, and the earnings weren't too bad. The group has been beaten down. Walgreens came in, beat top line, beat bottom line. They guided in line, so they didn't have any further warnings. And I think the market kind of took that and ran with it. We're seeing a nice movement to the upside. This potentially could be some type of a character change on the chart for Walgreens. Volume pretty heavy. We'll see whether or not we can finish strong today. And then finally, one of the drags in the Dow today is Boeing. More news out about the 737 weighing on the stock a bit. I would just watch 360, that level here. You can see after breaking below 360, we came back up, failed to get through. We finally did get through that level on heavy volume, so that now presents a little bit of short-term support. And notice both moving averages coming in right near this 360 level as well. So even though we got some negative news, Boeing is down, I would treat this still as a buyable type of a move down, so long as these moving averages and that 360 price support hold. All right, Erin, Thursday, getting close to the end of June, one more day after today. How are you doing?
I'm doing quite well. Yeah, all of our monthly charts are going to go final tomorrow, so I'm looking forward to seeing if we had any signal changes based on, the rally that we saw this month. So it'll be interesting.
Yeah, and for those of you maybe new to the show or maybe not as familiar with Decision Point, those monthly charts, I would say, are more important to a long-term investor, correct?
Oh, absolutely. But it does give you a really good feel of what the market condition is by knowing in the long term. I know you study charts a lot where you start from the big picture and then you start moving down from monthly to weekly to daily to hourly.
Mm-hmm. Yeah, I think it's important to take a look at that big picture. And I think it's always a pretty good idea to at least have some sort of a mechanical system in place, because otherwise your biases, everyone's got those biases Dave talks about, or has written about, and has talked about here on Market Watchers Live. And so you want to be careful that you're not so entrenched in your own bias that you overlook what's going on in the market. And I think that's where those mechanical systems can certainly come into play. We do have a special guest with us today. Bruce Fraser is returning again. Bruce, always great to have you on Market Watchers Live. How are you doing?
Erin and Tom, hi, I'm doing great. It's great to be here. It's been a long time.
Yeah, it's always great to have you. And I saw your presentation. I'm going to give just to let the cat out of the bag here a little bit. But as the economy turns, which I think is a great title, and I'm not quite sure where you're going with it. I'm kind of interested myself, but when you say that, and maybe just a little bit of like I said, letting the cat out the bag here a bit, but when you say that, are you seeing things that are making you think that things are turning back down?
Well, we'll both know after the talk's over I'm not sure either. But
Okay.
I'm going to make a case here for the economy, and so it's going to be interesting to go through it. There's a lot of moving parts here, but I'm going to be optimistic. But I'm going to be dramatic, because as the economy turns, is sort of sounds like a soap opera. And I know Market Watchers Live is the best in daytime television. And so I'm just going to try to add some drama to that.
Wow. I think you should just take over the show. I don't even know what to say after all that.
So anyway, I'm just happy to be here.
Well, we are always happy to have you, and I am looking forward to it. And I think, we have a lot of folks that watch the show, obviously, that are technically minded, but also, you're trying to look at the numbers and the charts and the price action. You're trying to, draw some conclusions between that and what we're seeing with the fundamental picture, which always is problematic for me, because, technicals are always kind of preceding what we see in fundamentals. So I think this will be an interesting discussion with everything going on around the world, for sure.
Well, I'll tell you what, Tom, my worldview is that you can tell everything through studying price charts. So you can study the data and draw your conclusions from that. That is what I'm going to attempt to do today.
All right. So you heard it here first. He's here to attempt. You're going to be stock chart Houdini.
Yeah, that's it.
All right. Well, we're going to get back to you in about 15 minutes or so. Let's go ahead and get going. Erin, what you got?
All right. Upcoming schedule. We are going to be premiering. Mary Ellen and I start a new show called Chartwise Women, and it will be premiering on Wednesday, July 3rd. The 4th of July, of course, is a day off for everybody. And for us, Tony Dwyer will be with us the following week. And do mark your calendars, as John Murphy will be joining us on July 11th. And then just a little bit of a teaser there. We're going to have Relative Strength Week in about the third week of July. So we are all looking forward to that. We have some great presentations planned. All right, today we did talk to Bruce, and of course he is going to show us as the economy turns. Gilead is going to be our first symbol, GILD, for the 10 and 10, taking your requests in the chat room, talking technically today, and we will finish with technical scans. And with that, let's go ahead and move on. What are the technical news and headlines?
All right. Well, we did have a couple more reports out this morning, a couple big ones. Of course, it is Thursday, so you can see the initial jobless claims there came in higher than expected. But also the final Q1 GDP reading came out, and it was as expected, 3.1%. So no big shocker there. But finally, and I think this was a pretty big one, at 10 a.m., May pending home sales came out much higher than expected. We've seen some not so great reports out on home builders of late. And keep in mind, all of these home construction type reports are somewhat dated. I mean, here we are getting ready to move into July, and we're talking about pending home sales from May, new home sales from May, and so forth. So just keep in mind that some of this data is a little bit stale, but it's all we have in terms of that area, that industry. When we look at the reaction to these reports in the 10-year Treasury yield, you can see that the overall trend remains lower. I do just want to point out one thing, and that is that the PPO is starting to move higher. Now, I wouldn't look at this and construe this as though the 10-year Treasury yield is gaining strength to the upside. Instead, what it means is it's just simply slowing to the downside. We had such a huge drop in May. You can see that the PPO just accelerated and went past all these prior lows in the PPO in the past. So it's just telling us that things had really accelerated to the downside in the yield. And I think that's what the Fed is beginning to come around and say, hey, maybe we do need to pay attention. But that move to the downside, at least for now, is starting to slow a little bit, and kind of gives me reason to, maybe take a deep breath and pause and think that maybe, just maybe, we will start to see a little bit of movement back to the upside in the 10-year Treasury yield. And as I pointed out yesterday on the show, when you do get these moves back to the upside, money rotates out of Treasuries, and it usually fuels a pretty good move higher in the S&P 500. And I think that's what we're going to get as we go into earnings season. I suspect we're going to see a little bit of a bounce in the yields. I'm not saying that a major uptrend will start from here, but I wouldn't be surprised to see a little bit of movement to the upside, and that would help the S&P 500. Also, what would help the S&P 500 is some strong earnings, and we did have some earnings out overnight. KB Homes was another positive coming out of the home construction. Just talked about the pending home sales. Well, KB Homes came out with a pretty nice report. I know Lennar had come out recently, and their outlook wasn't so great, but KB Homes got a pretty nice response, gapping up, and after their earnings report had come out. So that was another positive in that space. A couple of other pretty big companies coming out reporting better than expected earnings, but I do want to point you to that that Walgreens report, because the drug retailers have been under a lot of pressure. They're starting to maybe turn back to the upside, and if Walgreens could get things going, I think that would certainly help the overall group. So that will be one that we'll take a look at here in 1 second. But what I want to start with is KB Homes. KB Homes did come out with a really nice report. They beat on their top line. They beat on their bottom line. And you can see the gap up that occurred. Now, I'm going to give you something good here and something not so good. The good part is that KB Homes on this push back to the upside, is up right now 5.5%. Obviously, anytime a stock's up 5.5%, that's a good thing. The one problem is right now we're seeing that we had a breakdown at $25. We gapped up just above that level. We had gone through the 20-day moving average, but now we are starting to roll back over. That's not a great sign. Big volume. Can we see a relative breakout up here on KB Homes, or is this going to fail? All of that, I think, is something that we want to consider. Also, and I'll throw another piece of the puzzle here, home construction stocks are right now sitting right on this 20-week moving average, which in an uptrend, we generally will see some support. So this is an interesting area to get involved in home construction. And with that KB Homes report coming out pretty solid, maybe that gives you a little bit more reason to do just that. Another stock, WBA, Walgreens Boots Alliance, just spoke about it. This thing's been in a downtrend for quite some time, but I actually think this could be a very significant candle today. So we're going to want to watch this to see if we continue to push higher, can break above this gap resistance area over here, which is about $56. I think that would be very, very bullish here for Walgreens. So something to look at. This could be a game changer on their chart. One other company I wanted to mention in terms of the earnings, and that would be, let's see. I had it right here. There we go. I want to pull up McCormick's, MKC, because they did miss on their top line. They beat on the bottom line. They raised their earnings per share going forward. And when you look across here, this is a company that actually has been doing pretty solid versus food products. And food products are near a 52-week high. So if you see this group breakout, you do have one of the leaders with McCormick. And you can see after gapping down earlier, lots of buyers returning here. So this is one we want to keep an eye on. Okay, scooter mover of the day. Let's take a look back at the dashboard here. You can see the market, Dow Jones, turning positive again. That's nice. All right, I'm going to focus today on Acorn, AKRX. And the reason I'm going to do that is when we look at this longer-term chart, stretch it out a little bit, this stock had been in a downtrend, looked like a little bit of a change of character here at the beginning of May. We consolidated sideways and now making a breakout to a multi-month high in the stock. And it's starting to come off the bottom in terms of relative strength. So in that pharma space, which is more defensive and tends to do well over the summer, you've got a pretty nice stock emerging as a relative leader now, holding that 20-day moving average and breaking out again. So I think AKRX looks good. That's why it's your scooter mover of the day.
All right, time for some upgrades and downgrades. I will be starting, of course, with the upgrades. Our first one today is CenturyLink. It was upgraded today by Wells Fargo from a market perform to an outperform, so they're looking for some good things. At this point, they have raised their target from $12, right around here, up to $14. So I'm going to put my handy there. Okay, so yeah, they're just about here. That's where they've raised their target. Looks like they're making it's coinciding with the lows back here from December. Of course, not a great performer. It's been in decline since that top back in September. We saw a lot of stocks start to come back out in December and start going up, but CenturyLink not so much. At this point, that support level would be right around there at 9:45. And right now we're trying to get above the short-term overhead resistance at the top we had last week. Haven't quite been able to do that, but on the upgrade, I mean, at least Wells Fargo thinks we're going to make it up here to this level eventually. For me, certainly, I think that's a possibility, but I don't like the way the EMAs are set up. I think the PMO is starting to look encouraging as it bottoms above the zero line. So we could see a move a bit higher. I'd be looking at that 1250 area before I'd be thinking about $14. So and set a tight stop there, probably at the low that we saw on Monday. Or actually, that's Tuesday, because today is Thursday already. Okay, OC. And we're not talking about the OC. Owens Corning is who we're talking about. And you can see a really nice breakout right now. Let's see if I've still, yep, I've still got that going. So right now we've got overhead resistance at about 55.63 has been broken today. And it has been trading above that level all day long, which I think is also, positive for what we're seeing here on Owens Corning. But also notice a chart pattern going on here. All right, we start here and we move on up this rising bottoms trend line. Notice that if you take these tops that go across and then you have the rising bottoms trend line, you have an ascending triangle. That is a bullish formation, and the back of the napkin minimum upside target, you look at the size of the pattern from the first low to the first high, and that should give you an idea of what kind of a target you want to see on the upside. So if we are to look at that, I'm going to make another horizontal here. Oops, that's not what I want. I wanted to have a horizontal line. Here we go. So if I put another horizontal line in, and I'm going to put one down here too, just to give me some idea. You can see the length of the pattern right there. So if I bring it up, it's going to bring it all the way up probably into that $75 range. So let's see if we can make this a little bit. Yeah, there we go. So, see, looks like it's going to match up right about at that gap. It looks like it wants to go up and start to close that gap. But of course, we're talking a long way away. But I think it's encouraging to see that kind of a chart pattern. It was also, by the way, upgraded so it was upgraded twice. Seaport Global from a sell to a neutral, and B of A Merrill from a neutral to a buy. And their upside target is at about 72. So they're looking at the same things I'm looking at as far as that gap and possibly even the measurement on that chart pattern. Next one is TripAdvisor. D.A. Davidson upgraded TripAdvisor from a neutral to a buy. Their upside target right now is at $55. So let's bring that about here. There, that's close enough. I'm guessing that we're looking at about the top of this earlier that we saw the top back here on, it looks like March. Let's see if we can get this showing us. Yes, so right here, if you come down, you can see it was in around March 7th that we hit that overhead resistance and headed back down. And now it looks like we might want to make that move back up. And it does appear, at least for D.A. Davidson, they're looking for it to move higher. I like the the bottom above the signal line on the PMO. I think that's encouraging. All right, let's move to some downgrades. Brunswick Corporation was downgraded today from a buy to a neutral. Support here, let's get my horizontal. Support right back here. I'm going to stretch this back out. So we have support around $40.94, or about $41. Don't like the PMO. It did get itself above. It hasn't gotten above the zero line. My bad. We are starting to turn over on the PMO. OBV is pretty much confirming this decline, and I would be looking for a move down to that support level, like I said, around $41. There was no target by North Coast. And let's see, O'Reilly Automotive, buy to a neutral, and we're looking at support right there at about 350.24. Overhead resistance, of course, you could mark, oh, look at that, perfect match almost to the gap. I actually want to bring that up just a little higher to mark that gap. There is no target at this point. I would be looking, I'm kind of in the same boat as North Coast at this point. PMO sell signal, and we saw a break down below this low we had back in April. Next one and final one is Rio Tinto. And Rio Tinto was downgraded from an outperform to a market perform. So we're not talking about, we're moving to neutral here. We're not moving into, let me get this trend line. We're not moving into like a sell or something. Actually, I'm going to use my shape tools here to show you what I'm thinking about. Possible double bottom here, but not what I would call textbook, because really the double bottom should come off of a decline, not a rally. You could probably call it a double bottom and coming down into the pattern here, but the pattern started with this top, and so I'm not totally convinced we're looking at a double bottom here. And, we've got a neutral coming out of BMO Capital, but it doesn't look that bad. So I can see the neutral. We've got to get over that overhead resistance at the top, though, that we had back in mid-April. That's all I have for upgrades and downgrades. There's the list of what I went over and what I didn't have time to go over. I'll have that in the MarketWatchers live recap in this evening. All right, time to bring, actually, it's time for a break. We will be right back with Bruce Fraser. Can't wait.
Welcome back, everybody. And it is time now to bring back Bruce Fraser. Bruce, I know when you were talking about 13 minutes ago, you led us on and told us you really don't know which way you're going with this conversation, but I don't believe you. Are you there, Bruce?
Well.
Okay, can you hear me now?
Yes, there he is.
All right. See, I told you, this is going to be very dramatic. Daytime television.
You said it was going to be dramatic. You told me that you weren't sure what you were going to be talking about or which direction it was going to go, and then all of a sudden you were gone. So I was like, oh, wow. This really is going to be dramatic.
Well, I'm chasing my tail. So as the economy turns, I chase my tail. So this is today. I have I want to use charting, stock charts, stock chart analysis to look at the economy, see if we can draw some conclusions about really the big picture and where we're going to go from here, because this is such an interesting place. As a matter of fact, I'm grateful for the opportunity to sort of talk about this now just because of where the market is. And so let's get started because I have so much to do in so little time. So we have the Fed policy as of the end of 2018, which concluded on December 17th with a rate hike of Fed funds to 2.5%. We know that was the 9th rate hike by the Fed. So we know that rate hikes generally with a lag slow the economy. And so there's evidence of that happening. The other thing we have is we have tariff wars. And these tariff wars have the effect of increasing costs throughout the whole world economy and also have the effect of slowing economic conditions and slowing growth. So the third thing that we have is we have a currency war. And this currency war is resulting in a strong dollar. This is a tax on U.S. exporters. It has the effect of lowering prices of imported goods, but it has the effect of making it harder for exporters to sell their goods outside the country. This has the effect of slowing economic growth domestically. So we're totally in the soup. This is like, there's nothing good here. And so, but we do have hope. And so here we can see what is the antidote to the slowing economy. First of all, the tariff wars are still with us. The strong dollar and the currency wars are still with us. The Fed has not turned directions and started to lower their policy interest rate. So interest rates are still up. But we also have a stock market, and I'll show you this in a minute, that is very close to its highs. So what is the antidote to a slowing economy? Well, we can have lower interest rates. Lower interest rates spurs economic growth. The Fed, and that's largely a market function, and it's also a Fed function. We can increase the money supply, which is a function of the Fed. Lower the value of the currency. That can be done in a multiple number of strategic ways. Stimulate inflation, which the Fed has now said that they would like to see inflation rise. So they are looking at ways to stimulate inflation as a way to stimulate economic growth. Fiscal policy is another thing that can happen, and that's usually done in Congress and with the administration. And an example of that might be infrastructure spend, which we don't have. The other thing would be to reduce or eliminate tariffs, which has the effect of improving business conditions for everyone. And lastly, we have presidential politics, which comes into play kind of with a dance between the Fed and the administration going into an election year, which is next year. So, and we're going to get into these from a technical perspective, a Wyckofian perspective. I would like to announce that TSAA-SF, which is a not-for-profit technical society, has a phenomenal free webinar on Monday, which is Dow Theory Trading with Alex Ivanov. And he is or was a mentor of Richard Russell, who was really the grandfather of Dow Theory. And so it's going to be a very interesting presentation. All you have to do is go to tsaasf.org, sign up. It's free. It's going to be a lot of fun, and I'll see you there. Okay, so let's get started. So we can see here that this is the S&P 500 going back into 2015, really a dramatic uptrend that was stopped with the buying climax at the beginning of 2018, became range bound with an automatic reaction here. So we now have a range bound condition, and this range bound condition has been with us for 18 months. And here we are, right back on the edge here of the April-May highs and we're flirting with this area. And this is despite all the things that we just talked about. So the stock market has really reacted quite well after having a shakeout in December, had a very good rally into the first half of the year. And this very good rally in the S&P was somewhat stimulated by falling long-term interest rates, which we'll look at in a minute. But here we are right on the knife's edge. This is right on the edge of an important area of resistance, which we can see the buying climax, that resistance line there. We are slightly above it. We've upthrusted it. Upthrusting a resistance line can be a place that can be quite dangerous. So what would be the conditions by which we would see the S&P turn down from this level versus being able to stabilize here and turn up, break out of an 18-month trading range and go into a new uptrend? So we will look at some examples or some charts here that might help us with this. The shakeout was quite a dramatic exhaustion of the decline, and this rally has been exceptionally good. Well, I want to point out something that is a Wyckofian concept, which is notice the pullback here. This pullback, which at the time seemed kind of sharp in April, May, only went back about a third, roughly a third of the advance. And at that point in this support area, it found a good low and turned around and rallied right back up to the highs again. And this ability to be able to pivot right off of that low and rally right up to the sign of strength area here is, I think, a very bullish thing, and suggests that the market, even though it is at this important resistance area, has the potential to get up and out of this accumulation or reaccumulation zone. And we'll talk about why in a minute. So just keep this in mind. This is 18 months in duration. It's been a long time. The market has basically made no progress, but the rally that we've had since December has been quite dynamic. Okay, now here, this is like the three pauses that we've had in this really exceptional bull market. And these three pauses, the first two have been 21 months in duration. And underneath, I put some economic data. But you can see here that they went into a pause, went into a pivot, turned up and started a new uptrend. And we can see in the case of this one was 2011 to 2012. At the end of 2012, it went into a new uptrend. Here, 2015, 2016, late in 2016, it went into a new uptrend. And here we are in a very similar situation today. Well, what are the common characteristics that we have in these three pauses? Well, each of them were economic pauses. And in the case of this first one, there was a tremendous amount of fear that the economy was going to go back into another recession back in 2011, 2012. There was still an immense amount of fear. And you can see that the GDP growth was pretty lackluster. It was 1.6 at the beginning of this era. In the first year, 2.2 in the second year, and which is, pretty low. Unemployment rate, 8.5 as it began, 7.9 towards the end, very high unemployment. And then inflation dropped from 3% down to 1.7. So inflation, actually in each of these periods, these pauses, the inflation rate has been relatively mild and stable. And one of the things that the Fed will look at to determine their policy regarding interest rates is they'll look for an overheating economy. And one of the ways they measure that is inflation. And so the fact that the Fed raised interest rates 9 times since 2015 really belies the idea that we had an overheated economy, because arguably we didn't. Now, here we have GDP 2.9 to 1.6, unemployment's dropping, so 5% to 4.7, and then inflation 0.7 to 2.1. So unemployment is dropping from a very high level, which is very good news. And now what we have is we have GDP, as we saw in the first quarter, 3.1 from what Tom told us. And the unemployment rate is at 3.9 now, and inflation is not rising. So the interesting thing about unemployment at 3.9 is that when you get down towards full employment is when you can start to have true wage growth, and where employees become hard to find, have to pay more to get employees, and existing or employees that are at work in these companies are starting to see real wage gains. And this is something that I think that the Fed wants. They want to see the workers, they want to see employment starting to make real wage increases going forward. And so this is going to temper their interest in having continuing to tighten. Okay, so we're right at the edge, and this is why I call it the knife's edge here, because here we are just pushing up against this important resistance area and having a condition where if we have the right catalyst, we could jump out of here. I think that catalyst is tariffs. So let's look at what's happened, though, with interest rates, and we'll circle back to tariffs. So this is a very important thing. You've probably seen this chart before. I published this in blogs. I believe I've talked about it here. But notice what happened back in 2018. For most of 2018, Treasury bonds have went in. This is 7 to 10 year Treasuries have gone into a accumulation phase. So this is classic accumulation right here, and this set up a point and figure count objective, and you can see these counts on here. I'll show you the point and figure chart in a minute. But these were dramatic counts, and I actually only posted the first 2 counts because I thought, you know, this is just going to be a monster rally in bonds if it can get up to this 107.25 level. But in fact, it blew right through it, and it blew through my stretch count here of 107.91, 108.57. And this goes to the idea that the market, if we just study the technicals, the market will tell us where it wants to go and what it wants to do. And this is why I just look at the charts. I look at the price data series, point figure charts, vertical charts, and I let them do the talking. So here is the 10-year yield chart, and you can see it went from around 3.20 down to 2.02 since just from October, November of last year, a dramatic decline in interest rates. So even though the Fed actually raised rates on December 17th of the Fed funds rate, long before that, the Treasury market was cutting rates. And it's significant that the Treasury market was having a dramatic decline in interest rates and a dramatic rally in the bond market. So this is about, I think, a 13% rally. The TLT, or the 20-year Treasuries, rallied over 20%. And I'll show you those in a minute. But this is a very important way that the economy itself, the market itself, lowered interest rates ahead of the Federal Reserve. This is why we always want to look at the data series and not wait for official policy, because by the time that happens, the move is typically over. Okay, so here's this blog, if you want to go back and look at this, December 10th. And at that time, we had a jump out on the 7 to 10 year Treasuries that went, just get my little highlighter here. And you can see, if I can, here it is. Okay. Yeah. So you can see right along here, there's a jump out, and this jump out was right at the point where it said, okay, I'm ready to mark up. And this is at this point, I put in these objectives. The top objective I put in later, which is to here. And you can see that this is a dramatic, the beginning of a dramatic move. And I concluded in the blog, there's a substantial cause built for a rally. And that's exactly what we got. Okay, so I just did this chart. I wanted to show you another way to look at this. This is a 3-box reversal point and figure here. And I did 25 point or quarter point scaling. 3-box reversal, you can see it encompasses all of 2018 across here. And look at the count. The count goes right to within 1 box of the objective that we've just reached. And my belief is that even though, and I think Tom has a good point about that, bond prices could pull back some here, that just bonds being in this level of interest rates is very supportive of the economy because these rates are going to stay down here and they're going to probably either just pause or build a new cause or whatever, but I don't think that they're going to move much in the near term. Now, this chart is the TLT, which is the 20-year, and I have a very important reason to show this to you, because here you can see back in 2015-16, which remember, this was the last turn that we had in the stock market. Remember that 2015-16, the economy sort of stalled out, the stock market stalled out, went sideways for a period of time. Well, look what happened. The 10-year, now this is 10-year yields. I should have put 20, so I apologize for that. But it really tells the same tale. And that is, you can see that the bond market started to drop interest rates, and they went from 2.5% down to 1.4 and produced a dramatic rally. Look at that beautiful climactic surge, stop the advance. Well, look where we are. We're right back where we were before, right there. Important resistance, probably a reason why the market will pause here for some period of time. But look at this, with a lag. Okay, so we have the interest rates right here at 2.5. You can see that they went down to 1.4. I'm just going to draw a line straight down to the stock market. Well, notice this. The stock market had already started to rally and was in the beginning of a very important advance, which took us right up to the climax at the beginning of 2018. So here we have this now this big trading range, which we just talked about. Well, look what's happened here. Family resemblance. Rates have gone from 3.2 down to 2.02. Now that's on the 10-year, a little bit more on the 20-year. But look at this. With the lag, a low was put in. The stock market started to advance. The stock market started to advance with a lag at the beginning of 2016. We're seeing the same thing happen here with the S&P and the bond market. So already we have this really great rally with capacity with all of these headwinds, tariffs, rising short-term interest rates, rising dollar. We have a stock market that's right up against its highs. So this is very encouraging. Okay. So this is the 20-year. What's most interesting here about this is notice that we have a fulfilled count of this area of the 2018 accumulation area. Well, we also have a higher count. So is it possible, I just put this out as a question, that 20-year treasury bond prices could even go higher and rates could go lower? This point and figure chart suggests that there's the potential to do that. Okay, got to keep track of time. Not going to spend much time on this. This is the yield curve. So as this line drops, it means the yield curve is flattening. I wrote a blog on that back in December, so you can see yield curve inversion and read about it. This is the 10-year and the 2-year. So this is what we're comparing in this yield curve. But get this. Look at how the curve is starting to turn up or steepen. That, just looking at that chart of that data and seeing it rising, tells us that the yield curve has stopped flattening. It's starting to steepen, and this is accommodative to the stock market, and it's accommodative to the economy. So here you can see it also in this 2015-2016 period. We can see flattening of the curve, and then it started to turn up and steepen, and that helped to produce the easy money environment that helped the stock market to rally up and out of its prior trading range in 2015-2016. So we're starting to see that if the Fed cuts rates in the near term, say in July, and maybe again later in the year, this is going to steepen further. That line's going to keep going up. So the other thing is that the market has already steepened in that if you compare T-bills, so I just wrote this down last night. I was talking to my dear friend Joe Turner, and we were talking about this, and I thank him for his help. is that the Fed funds rate's around 2.37, 2.38 right now. Well, the 26-week T-bill is currently at 2.13. It's below the Fed funds rate, which is not a typical relationship. Normally, the Fed funds rate is lower. So even the T-bills, the 26-week T-bills are saying that there is easing coming. There is a rate cut coming from the Fed in the not too distant future.
Hey, Bruce.
Yeah.
Good time for a question here, because if you go back to that chart you just had up.
Sure.
Okay, if you look back on the chart in 2016 when that yield curve started to turn back up again in the last 4 or 5 months.
Right.
If you look back to 2016, you would see that same type of movement up in the financials, the XLF versus the S&P 500. So in other words, that turn up in the yield curve led to significant outperformance in financials. And what I'm seeing now is we had put in a bottom, what appears to be a relative bottom in the XLF versus the S&P 500 back at the end of March.
Right.
And that occurs just about the time this turn is coming up in the yield curve. And if you're suggesting, if the Fed does lower Fed funds rate and that curve really starts to accelerate to the upside, would you then also make the assumption that the financials would be an area of the market that you want to be in over the next couple of months?
Yes, I'm pretty excited about the financials. I think they have a lot of potential in here, and I think they're undervalued. I do believe that they need some help from the Fed in terms of being able to steepen the curve so it's easier for them to make money. But there's deep value there, and this turn is going to really help them to become more profitable. And they're already, pretty profitable, well-run businesses, unlike 10 years ago.
Right. And I also want to point out, if somebody's looking at it, they'd say, well, what about the, fact that for a while we were seeing outperformance by financials, even though the yield curve was going down? And what I would say is that there are areas within the financials that are not as severely impacted by the yield curve moving lower. So more specifically, I would be looking at banks, life insurance companies, maybe investment services. Those are the ones that seem to be much more correlated with the direction of the yield curve. If that yield curve starts to move higher, and I audited banks when I was in public accounting, so I know the impact of the net interest margin on these banks when you start seeing that yield curve move back to the upside. So more specifically, I guess, than just financials would be, in my opinion, the banks and the life insurance companies, which tend to move much more in correlation with the direction of the yield curve.
Well, and just to add to that, the banks and the insurance companies, which the insurance companies look really good right now, have seen a 10 to 20% increase in the value of their bond portfolios in 2019.
Wow.
Yeah. So this helps them a lot. And when you steepen the yield curve, it makes it easier for banks to lend.
Mm-hmm. And increases that spread.
Yeah.
Yep.
Good point.
Okay. I didn't mean to interrupt. I just
this is good.
Yeah, I thought that would fit right in with those financials.
It's just that you guys are going to cut off my mic at the most unopportune time. And
don't worry about it. You got 13 seconds. Kidding.
Anyway, this is from a blog. Now, by the way, I'm going to do charts of stocks and industry groups in my power charting video tomorrow, which is going to be which I'm calling part 2 of this presentation. So I'm going to show some ideas that I think could benefit in tomorrow's video. So please turn to that. And now we're going to turn to the dollar. And so you can see here that the dollar has been running up into, look at this dramatic trading range that goes all the way back to 2015. So notice that in 2015, 2016, the dollar actually weakened, which can help the economy to kick off. But then it got very strong again. Look at this incredible rally in the dollar. Unbelievable. But climax automatic reaction, a range-bound condition that goes all the way back to 2015. Well, now look at this rally that we're having. this long, laborious advance is a diagonal triangle. So each one of these rallies and reactions has become more muted as it gets further up. And my contention is that this whole area is distribution of the dollar, and the dollar is going to have a break. That break in the dollar is going to be good for the domestic economy. It's going to increase inflation, and it's also going to be good for exporting. Now, there's two messages I want to give here, and then I'm going to zoom into this chart quickly in a few minutes. And that is that gold, which is this bottom chart, tends to run counter or inverse to the dollar. Strong dollar, weak gold. Strong gold, weak dollar. And it's because the gold is a currency surrogate. So you can see here, again, strong dollar, weak gold, et cetera, et cetera. Well, look what happened in 2018, 2019, and go back and look at my August 2018 blog on gold, and notice that we've had this terrific rally in gold while we had a rally in the dollar. So a change of character. And this change of character suggests that there's something internal, a strengthening in the gold market that is showing up irrespective of the dollar being strong. So gold is gaining value in the strongest currency. And here you can see there was an attempt to back up. And on this backup, there was a top built in gold in the dollar, which I'll show you a little more closely in a minute. And this top being built in the slightest volatility and decline in the dollar, and look at gold just take off. So this whole area here was tipping the hand that something was different in the gold market. And I think that gold is sniffing out that there's a change coming in the relationships of these major currencies. This is a distribution on a rising scale in a diagonal triangle. This is the area we just looked at. And I have done a blog on this that you can go back and look at this chart with one change. I'm calling this an upthrust after distribution. So it upthrusted this area, and then with volatility, it's fallen right out of the channel. And I believe that this whole area here is distribution, and that when you have an upthrust after distribution and a failure, these markets can and typically do move relatively quickly down to an important support area. And so I believe this automatic reaction that I've drawn is an important support area, and I think that the dollar could go there and go there pretty quickly. So this could be, and you can see here how gold has just taken off with already with just the slightest decline in the UUP, which is my surrogate for the dollar. Okay, I'm going pretty fast here. The only thing, you've seen this chart before, the only thing I want to show you is the month of June. So this is a 7-year downtrend in gold. And we've been posting this chart for a long time. Look what happened. It broke above its long-term downtrend and went right up to this important resistance area that goes all the way back. It was formed in 2013. And so here we are right at that area, which is around 1410. And we'll see how gold reacts to that, whether it pauses here for how long. My expectation is that gold will just pause and not pull back very much. And because I believe that there's a lot of short covering that needs to take place, and there's a lot of shorts that are basically trapped here right now at this resistance area. So this is going to be very interesting to watch, and go look at my August 2018 blog on gold. Okay, well, and then
I was just going to say, I think one thing maybe to consider too with gold, and we had this discussion, I think it was me, Erin, and Julius when he was on last. We kind of had a little roundtable about gold and so forth. And And what we looked at was not just the direction of gold, but the direction of gold relative to the direction of the S&P 500 and whether or not gold will outperform the S&P 500. And I don't know if this is a good point, for stopping and maybe just to kind of talk about that. But for me, I think all three of us, Julius, Erin, and I, all thought that gold had more upside potential here, especially with a weakening dollar. But I don't think it's going to outperform the S&P 500. Do you have any thoughts on that? Because you were talking about both going up. Do you think one goes up faster than the other?
I believe gold, gold has really outperformed since August of 2018. And it's been really leading the way. And this resistance area is quite formidable and very important. But here's putting my Wyckofian hat on, is that this entire area looks like a big accumulation. And what happens when you get into the late parts of an accumulation is notice the higher lows. So every time gold would pull back all the way back into 2015, every time it would pull back less into a higher low, which tells me that there's systematic accumulation by very large interests. And so once gold is well accumulated and in very strong hands, then it can move easily upward because there's very little gold available to be bought. And so there's a shortage of gold in the marketplace to be bought. And so this would be my concern here, especially for the short sellers that have been shorting gold now for years, is that now just the short sellers could be the fuel that could drive gold right out of this accumulation area. But we're at the top of it now. So there's a number of things that could happen. It's run dramatically up to that 1410 area, but it could just as easily pull back really hard off of that. But it is above this downtrending trend line. And so I suspect that what it's going to do is it's just going to pause here. And it's just going to hang out at this area and then start to rally again. I do think that gold can perform with or better than the S&P, just because of that big accumulation area.
Yeah, I would, I'm going to disagree with you, if that's okay.
It's perfectly okay.
It
kind of scares me, actually. It's like, oh no.
I did come in that discussion. I said that it would outperform.
All right.
Mm-hmm.
Yeah, I just
2-1.
Yep, always.
I like it.
I'm going to go ahead and I'm going to share a screen. We're going to need to move on, but I do want to just show you the gold versus the S&P. And I know you had said that, since last year it's moved up, but the overall trend to me is still to the downside. And so we did have a nice move up in the fourth quarter when the S&P got hit hard. We had another big rush up in May when, once again, the S&P 500 got hit hard. But when we look at periods when the S&P 500 is doing well, I mean, I know, for instance, I am not going to be thinking about gold if the S&P 500 is breaking out the all-time highs. And I don't think a lot of investors will either. I believe that
I agree. Yeah,
if we do
totally
break out on the S&P, I think that's going to create a reason for some of those holders of gold to get out. And maybe that's a little bit of a fundamental discussion, not a technical discussion. We need to watch these charts. If the dollar falls the way you think it is, then I agree with you. I don't think it's going to fall that much, but we'll see. I mean, that's what makes the market, right?
Right. I totally get that. And I had a conversation with a friend recently and said, you should have, say, 10% gold type stocks and gold in your portfolio. They were horrified. They're like, oh, you've got to be kidding me. It's just like, no way. It's just, I may have lost him as a friend. Anyway, the only thing, my only conclusion here to make is that I think that everything is moving in the right direction. The Fed is going to cut rates probably in July. And this could happen soon, is if there's a resolution to this tariff war, and I don't know that there is, but if there is a resolution, I think the market is going to like it. And if there isn't, and we're right on the knife's edge, and I wish I could be clear about this, but it really does turn on that. But if there isn't a resolution to the tariff wars, or there's disappointment about that, I think the market could turn off this resistance and try to go back down again. But I do think generally everything's moving in a bullish direction. And if we get a big jump out of here on, say, some tariff news, it's just the beginning of, I think, the potential for a really good long-term rally in the market.
Yeah, I think the catalyst is going to be earnings coming up, and with the Fed being more dovish, I think that more companies are going to raise their forecasts going forward, and I think the tariffs could just add to all of that.
I love it. Yeah. There's all these things that are at work, right? They're all good. Yeah.
Yep. Well, we do need to move on, but you gave everybody a lot to think about. Great presentation. We weren't getting much going on in the chat room, and I think that tells us everybody's listening in pretty intently to what you had to say. Great presentation, Bruce. Always a pleasure to have you on the show.
Oh, I love being here, and everybody have a great holiday next week, and we'll do it again sometime soon.
All right.
Sounds good. All right, it is time. We are just going to jump right into the 10 in 10. Try and go through some of these pretty quickly, but first let's start off with Gilead. That was the first one today. A couple things I like here. Number one, I like the fact that biotechs have started to rise in June. We did pull back, starting to move back off of that. It's one of the best performing areas of the market today. Biotech's doing pretty well. And if you notice, Gilead last 3 or 4 months has been outperforming its biotech peers and thus far bouncing off that rising 20-day moving average. I'd like to see it hold that 20-day as we go forward.
All right. Let's see. The most popular in the chat room is Disney.
Yeah, I've been a fan of Disney. I think we've got a beautiful cup setting up here with a possible handle. It's in a great area of the market. I could not be more bullish Disney. I think Disney's going to break out. I think we're going to get a nice move to the upside. So here's your uptrend. And there is, just kind of draw this right in here. But you can kind of see a cup. Look at that handle right there. I think this is setting up beautifully. Break above 142.50, I think takes us to 155.
All right. The next one we're going to look at is, I think I'm going to give you Guardian Health, GH.
Yeah, I know this was a stock that was doing really well, pulled back over the past few weeks, but I think still looks really good. I'd watch that 50-day moving average and the breakout that it just had above the $80 level. So right in here, see all these tops failing at 80. Then we go through with that increasing volume. Now as we pull back, we've got that plus that 50-day moving average coming in at 77 and change. So I think you can enter in the low 80s, even the upper 70s, and still be fine on a reward to risk basis.
Okay, next one up is going to be Skyline Corp, and they're in home construction. They're actually looking pretty good as far as the RRG, whereas Pulte is not. So what are you thinking?
What's the ticker for Skyline?
Oh, I'm sorry, Sky.
That one I wasn't familiar with. I know a bunch of them. I like first of all, it's in that home construction area. So the group has been pulling back recently, but overall it's been pretty strong. And here you can see the Sky relative to the group is at about a 7-month relative high. And technically it's bouncing beautifully off the 20-day moving average. So in annotating, I think the relative strength is an important component here. But I also just like the fact that we're seeing such perfect technical action here off of these 20-day tests, which I really like. So I think it's trading well. I like the stock.
All right. Next one is Floor and Decor Holdings. That is FND.
All right, FND, Home Improvements. We could be seeing an inverse head and shoulder pattern. The relative strength I'm a little concerned with. So if it fails, I would certainly be out of the stock. I think we probably could find better stocks within the space. But what I'm looking at here is that coming across, left shoulder here, right shoulder here. If we get back up and break through this 43 level with some increasing volume, that would actually measure up another $8 to about 51, taking us not only past this high, probably up here challenging the highs we saw a year ago. So I think that there are some things to like here. But again, if we go back, I would even say below the low we saw earlier this week. Let's say a move back below 38, I'd probably be careful here. Okay,
next one I have up for you is Kydell Corp, QDL. DEL.
Yeah, move up, sideways consolidation, gap down. I think there's a key area. You look at the relative strength, not good. So I don't think I would consider this stock until it could get through this area of resistance. And what I'm looking at is after we gap down, the close was right here at about 60.5. And intraday after this move down on big volume, the best we could do is get up to 62.5. So that to me is where the sellers are likely going to sit on any move to the upside. I would wait. I don't like it. I think there are too many other stocks in the medical supplies area that I like better. So I wouldn't do anything with it. But if I was in it, I think, again, I'd watch the low from yesterday. I wouldn't want to roll back over again here.
Okay. We haven't looked at this one before. From Business Support Services, INFO.
Yeah, they just reported, IHS Market just reported earnings, had a beautiful move up. It's part of the really strong area. Relative strength is good. I think this is awesome. I just don't want to chase it. So I think the two key areas to watch here would be that breakout right here above 61. And then on any, if we did fail to hold that level, I would just watch this 20-day, which has been holding very nicely. So I think between $60, $61 is your key support.
Okay, next one up is for our friends in Canada, West Dome Gold Mines, WDO.TO.
All right, WDO. Oh, that's not going to give me the relative charts. So let's pull it up on this chart. Yeah, I like this 20-day test here. Nice volume on the way up. I think the latest breakout was right here at about this 505 area. So I'd probably watch that level, make sure that doesn't give way. But yeah, PPO looks good. We pulled back right to the 20-day, bouncing off of it. And this is what I was talking about in terms of the volume. This move up came on very nice volume. So I think it's all trending in the right direction. The only thing I would say, again, is I'm not a big long-term fan of gold. I'm a little different, I guess, than some of the others, some of the other analysts here that have been on the show talking about gold. I'm just not sure about the gold's relative strength going forward versus the S&P. So that's why I'm hesitating. But I do agree with the weaker dollar that gold in the short term is certainly a good area to be trading right now. And I think WDO bouncing off the 20-day is good.
All right. How about Cadence Design, CDNS?
Love it. One of my favorite software stocks. We can pull it up. Actually, let me go ahead and pull this up on the relative chart. It hardly pulled back at all when software was getting hit. We've seen a number of stocks pull back, 10, 15%. Really good ones that had been outperforming. CDNS barely budged, didn't even test its 20-day. So what you've got here is a stock that it just continues to show excellent relative strength. And so what I would chart here is just the fact that software is going up. The stock is going up relative to software, relative to the S&P, and there's software relative to the S&P. So you got one of the best stocks in one of the best industries and one of the best sectors in the market, and that usually translates to a win. So I like the stock.
Okay, this is a pretty ugly chart. I don't see any redeeming features. Maybe you do. BlackBerry, BB. That'll be our last one.
Yeah, they just reported. I mean, yeah, there's nothing to like here. Even on a relative basis, when it did move up here and started to move up here, you can see the overall relative strength versus the telecommunications group was not good. It's breaking down to new lows, and the price support just gave way. And this is in a market that's near its all-time high. So again, using relative strength, I have no interest. I think BlackBerry is going to fall back to test its December low around 660, 670, something like that. I don't have any interest here.
All right, that completes the 10 and 10. Here are the stock symbols that Tom just annotated. You'll find those in the MarketWatchers live chart list. Go to the articles tab from the homepage, click on the MarketWatchers live blog, and the link to the live chart list is right there at the top. I'll be back with the final market update after this.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have Chart School and creative strategy videos to help you become a better technical trader. leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Hi, I'm Arthur Hill.
And I'm Julius the Campenaar.
And you're watching SCC TV.
It's time for our final market update. Let's take a peek at what the markets have been doing. And you can see we started off in negative territory for the Dow, but we have managed to rally up into positive territory. The Dow is up just over 40 points. The S&P 500 up 13 points, looking like it's going to challenge that intraday high we set earlier this morning. It is up 0.45%. The NASDAQ is it had a nice gap up. Looks like it's challenging those intraday highs as well. The NASDAQ is up 0.68%. New York Stock Exchange, a big move in the morning, pulled back slightly, and now we are starting to set new intraday highs. The best performer today, it has been lagging for quite a while, but Russell 2000 is the best performer today, up, 1.25%. The Canadian markets, the TSX, continuing in a downtrend here, really not coming out of it yet. You can see declining tops trend line would show you that that trend is still in place at this point. Treasury yields are falling, as we said earlier today. It's at 2.021%. VIX is falling. It is just below 16 at 1596. UUP is unchanged. Gold is down, GLD just 17 cents. USO is trading mostly sideways in a trading range that began after the gap up yesterday. And TLT on a nice rally run, really not pulling back at all, continuing to make intraday highs. As far as our sector summary goes, the leader today, right now, is the financial sector, up now over 1%. And one laggard, and guess which one it is? The energy sector. It is down slightly. The rest of our sectors are higher.
All right. As far as the update goes, I did want to show you one thing here on your dashboard. And I don't know how many of you use this, but Market Overview gives us some very basic information, but there is this button here right below, or the link to the market summary. And if you click on that, you can come in and look at the charts. You can also do it in table view if you want. Then you can sort it based on percentage change. But it quickly gives us an idea of what's leading the market, what's not. So you can see the NASDAQ doing well today, S&P not so much. Transport's leading. This has been a group that's really struggled of late, as have the small cap stocks. And you can see Russell 2000 and the S&P 600 also, doing very well today on a relative basis. We talked with Bruce Fraser about the possibility maybe financials are going to lead as we go forward. You can see that is occurring so far today. And then within the industry groups, I mentioned biotechs, we're starting to rally again. You can see that here very quickly. It just gives you a lot more detail that we don't normally see when we just go, say, through maybe the sector summary. And for more on the market summary, let's check out this week's Talking Technically, where market legend John Murphy discusses his use of this StockCharts feature.
I'd like to show you how I use the market summary page, not just to find out what the market is doing on any given day, but to find out what's leading the market up or what's leading the market down, so I can take a closer look at those particular parts of the market. Now, there are two versions of the market summary page. One is the table view, which just shows all the major indexes, bonds, stocks, currencies, and everything else, and it tells me which ones are up and which ones are down. That's part of it. Then there's the chart view, which actually shows me the charts of each market. And I'm going to show you how I'm going to combine those two in today's market. Okay, we're going to first of all, we're going to go to the table view, which is the market summary page. And you can see that we're just going to look at the major indexes here. They're all red. All of them, starting with the Dow, the NASDAQ, everything is red, with one minor exception, the utilities. We won't talk about that today. Notice all the lines are red. But if I'm really interested in what's leading the market, where's the real story here today? You can see this arrow here, this red arrow, that is the Russell 2000 small cap index. And then we go to the second red arrow here, which is small caps as well. That is the S&P 600 small cap indexes. So right off the bat, without even looking at a chart, I know not only is the market in the red today, but it's being led lower by small cap stocks. Now I want to take a look at the chart and see if there's anything significant going on here. So I simply go to the top of the chart here and I click on Chart View, very simple, and you'll notice I automatically see a chart of all the indexes. And my main focus, since we're talking about small cap stocks, that's the one right here. And certainly, and as you can see, there is certainly something going on today of technical significance. First of all, this line here is the 200-day moving average. That is a long-term resistance area. Small caps have been rallying. They tested it and failed. So they're starting to break down a little bit. That's not necessarily a good sign. But look at what's going on with this last bar here. This blue line here is the 20-day moving average. It's kind of a short-term moving average of market trends. And notice that we are breaking below it today. That's the first time that the small cap index has broken that support line in 2 months. So three things are going on here, actually. First of all, the small cap index is failing at a major resistance level. It's breaking a short-term support level, which is not a good sign. So it's telling us that small cap stocks are starting to weaken. And the triple message to me is that when small caps start to weaken, that's normally a sign that large cap stocks are going to start to weaken as well.
It is amazing to see all of the different views that you can now do with that market summary. That was a great wrap up there with John Murphy. But now it is time for technical scans. So I'm going to dive right in. What we're going to do is I'm going to look at the Advanced Scan Workbench, but you can also go down here to the scanning. You can also go in and look at our predefined scans as well. But today I'm going to just concentrate on our Advanced Scan Workbench. I don't generally use the standard scan workbench, but it is sort of an easier way maybe for beginners to start setting some of their scans up. But I really prefer the advanced scanning workbench because that's where I do all of my writing of my scans. So I thought I would start here and show you a few of my scans to begin with. And there is an advanced editor, which I have on. It's all colorful, but you can also move back to our older editor that we had before. So you can get right back there in case you miss that. But I do like the colors. It does help me quite a bit. So I have quite a few scans. I'm going to start off with just a general scan that I use with my price momentum oscillator. You could certainly do the same kind of scan with the MACD if you'd like, and use this as a framework. Instead of using the PMO line, you could use the MACD line if you'd like, or the PPO. Either way, they both work pretty good. So, but of course, I'm partial to my price momentum oscillator. All right, so I just wanted to explain some of the items I do have in these scans, and I have printed all of these scans in previous blogs. And today, since I am going to go over 2, possibly 3 if I have time, I will print these in tonight's MarketWatchers live recap. So if you want to go in and copy my the scan code, you can do that directly from the MarketWatchers live blog, and then you can go in and maybe tweak it to work for you better. You can take out some lines, but let's look really just quickly. This is my general scan, and I've done presentations on this scan. I have tweaked it over the years, but this was sort of my basic scan that I started out with. I think it's still a useful scan, but admittedly, I don't really use it as much because I have moved into a different scan that I really like right now. And I have done, I think I did a blog on that one in ChartWatchers like a week and a half, 2 weeks ago. So you could probably find it there. All right, so you can use, this is an excellent tool, and that is comment lines. You just put in those 2 hash marks, and then anything after that on that line, the scan engine doesn't pay any attention to. So I think it's very helpful for you to use comment lines so that you can figure out what you were setting up before, because sometimes you might go back to a scan and be like, I can't remember what that couple of lines was for, but now if I have the comment section here, I know exactly what this, for example, this area is pretty large, right? So it's nice to have a comment that just tells me this is identifying a PMO that has been rising for 3 days. So this scan I would use as my basic scan just to find stocks that were, of course, I like to see the volume at least on an average above 100,000 at a minimum, but I do prefer it to be even more like 200, 300,000 at least. But I do include those in the scan anyway, because I can make that decision later. I prefer to look at stocks that are over $10. It just, to me, it helps a little bit with the volatility. It does keep out the penny stocks, which is really the point of this particular line of code. And again, you can tweak it and maybe make it $5 or $3, just depends on what you like to trade. The next one is I look for a PMO that hasn't crossed above its signal line. So, I need a PMO line, today's, to be less than the PMO signal line. And this is so that I can get into a stock before it's actually had that PMO buy signal. But I don't want to look at just any PMO that is below its signal line. I want to make sure that it's been rising for 3 days. And so that is what that comment is telling you there. And then the IT and long-term trend model configuration for decision point. We like to see the 20 above the 50-day EMA, 50 above the 200. This tells me especially that the stock is in a bull market configuration. That's how I look at the 50 and 200. If you have a long-term trend model sell signal where the 50 is below the 200, you're taking a chance. In my opinion, you're looking at a stock that maybe, it's been beaten down, and if that's what you're looking for, go ahead. But for me, I do prefer to invest in a stock that I know is already, pretty much in a setup for a move to the upside. And then at the end, I like to look for those StockCharts technical ranks that are above 75. So that tells me that I'm already looking at a stock that has some, excellent relative strength in comparison to its peers, whether it's small, medium, mid-range, or large cap. So I'm going to just run this scan really quickly. And I've done, oh goodness, I know at least 1 or 2 workshops on scanning, and so here we go. We ended up with 0 results. So this means that the scan is a little too picky for right now. And that's fine. What I like to note is that if this general scan isn't finding anything on that day, you should take note. So that means there are quite a few stocks out there, but none of them are really in a position to break out in the way I'd like to see. All right, we'll move back here. So if you wanted to use this scan and still, maybe get some results, here are some things you can also do. So we talked about that comment line, right? The double hash marks. Well, you can use that to comment out some of the parameters in your scan. So for example, let's see if we comment out the 20 being above the 50-day EMA, let's see if we end up getting any more stocks. And I ran the scan, still no entries. So let's go ahead and say, okay, well, maybe it doesn't need to be rising for 3 full days. So maybe we'll just make it 2 days. I'll comment that out. Let's see if that helps. 10. So see, we opened up our scan a little bit simply by using those comment lines. And so that's one of the things that sometimes I will do in order to just, like I said, get a few more results, see what maybe sectors are looking the best, what kind of industry groups am I getting on the scan. It can tell you what stocks are leading or maybe might be on the way to leading. So I should, of course, talk to you very briefly, at least, about the scan that I've really started to groove on. I really like it. It's not that much different than this one, but the parameters are slightly different. So when I first did the scan, I used to have the daily volume at 100,000, but I ended up getting a lot of results out of this scan. And so I decided that, you know what, I prefer them to be trade more shares. And so why don't I just make this a little bit more confined and make it 300,000 instead of 100,000. Here is the PMO rising for 3 days. But what's missing from the other scan? The PMO being below its signal line. That's out of here. I don't have that in this scan. So I'm allowing stocks that are already on PMO buy signals. And I'm looking for those that have been rising for 3 days. So they're continuing their momentum swing to the upside. And I'm keeping in the 20 being above the 50 and the 50 being above the 200. And then this is new. So instead of just looking at scooters that are above 75, what I have done is look at the mid-range scooters from 70 to 80. That could mean that they're on their way up with relative strength. So you might be catching a momentum move a little bit earlier. They could be on their way to that hot zone and moving as a leader in their group. So I'm going to run it, and then we'll just take a quick peek at those results. 39 today. I didn't have to comment out anything. I find it interesting. I get a lot of ETFs for whatever reason on this particular scan. But what I have to do first, and I'll just show you this real quick, and then we'll wrap this up. I always save it to a transient list, my scan dump. And so then once you're there, then you can start manipulating it and looking at candle glance or looking at it 10 per page, however you wish to do it. And that's all I have for the technical scanning. Hopefully that was helpful. And like I said, I will put both of the scan codes into the MarketWatchers live recap.
Yeah, very, very good. And for those that are momentum traders, I think those scans really would help in trying to identify these stocks that are making big moves and are climbing that scooter ladder relative to their peers. And that's really what you want to get into. You want it as a momentum trader anyway, you want to catch those that are moving higher.
Yep. I'm very dependent on my scans.
Yeah. And I actually have a separate chart list that I use, a watch list. And there was a question that was in the room earlier asking about how many stocks we keep on a watch list. I can tell you for me, I keep a strong earnings chart list that only puts stocks in there that, companies in there that have beaten Wall Street estimates in their latest quarterly reports as to both revenues and earnings per share and look good technically on their chart, or at least look okay to me. Mm-hmm. And then I put them in this list, and I have 280 in there right now. I don't know. Do you keep a watch list, Erin, or do you just use your scans to identify?
I just mainly use my scans to, when I'm in a position, I know, okay, financials are getting ready to explode. Well, I don't know if that's totally true, but certainly, they're showing a little bit of improvement. So I'm like, okay, I have some money in my account. I'm going to go ahead and do that. So I run my scan. A lot of times I'll change the date so that it's looking at the past month, maybe. And then go from there, look at my scan dump. And then, of course, my watch list has my holdings. And I generally don't add too much to it because I do scan. That's just really, when I'm ready to buy, I want to know right now what's looking good. And that's how I use my scans.
All right. Well, here is the poll, because we talked, that was in the poll today, was about scans and how everyone uses the scanning tool here at StockCharts. And I'll tell you, the one that really stands out to me that I really am happy about, and I think Chip Anderson, if he was here, would probably be agreeing. I write my own scans 51%. I think Bill Shelby also would be really happy to know that 51% of our respondents write their own scans. That's awesome.
Oh, it's super if you have your own method. You can, again, I have my method of analysis. And so I put in all the things that are very important to me. And, that's the best part.
Yep. And the thing is, the scan engine is powerful. When you go to write your scans, there's so many things you can include or exclude to get that scan exactly the way you want it. And it cuts down trying to go through thousands of charts to find what you're looking for. Mm-hmm. Okay, there is your upcoming schedule. We got a lot on the schedule. Remember, no Market Watchers Live on July 4th, of course. But otherwise, do want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located below the video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.